Hey there and welcome. You ever look at a huge company and just wonder, how do they keep track of all their stuff? I'm talking factories, machines, even the office computers. Well, guess what? There's a rule book for that. And today, we're going to dive into the story it tells. This is your 5-minute guide to IAS 16.
So it really all boils down to one simple question, but with a super complex answer. What is a company's stuff actually worth? I mean, is it what they originally paid for it? Is it what you could sell it for today? Or is it something else completely? It gets tricky.
And that's exactly where International Accounting Standard 16, or IAS 16, comes into play. Now, I know what you're thinking. Accounting standard. Sounds kind of boring, right? But don't let that name fool you. This isn't some dry, dusty rulebook. Seriously, think of it more like the biography of a company's physical backbone. It tells the whole story of how a company invests in itself, builds for the future, and, actually creates value.
Okay, so to tell this story right, we first have to meet our main character, and that's the assets themselves. Now, accountants have a specific name for this stuff: property, plant, and equipment, or, as you'll hear a lot, PP&E for short.
So what exactly is PP&E? Well, according to the official rules, it's the tangible stuff, things you can actually touch, that a company uses for more than 1 year, either to produce its goods or just to run the business. Let's make this real. Imagine we start our own company. Let's call it Explainer Co. If we go out and buy a brand new, high-tech 3D printer for our factory, boom, that printer is a perfect classic example of PP&E.
All right, this brings us to the first act in our printer's life story, the moment we buy it. So, what price do we put down in our accounting books? Now, you'd think easy, it's just the price tag, right? But nope, IAS 16 says we've got to dig a little deeper than that.
See, the standard is actually super clear on this. The initial cost has to include everything it takes to get that asset up and running just the way we want it. So for our 3D printer, we're not just talking about the sticker price. Oh no. We're talking about the shipping costs, any import taxes we had to pay, the fees for the specialist who came to install it, and even the cost of the first few materials we used to test it and make sure it works. You take all of that and you bundle it together. That's its initial value.
But, and this is a really important but, some costs just don't make the cut. For example, what about the cost of training our staff to use this fancy new printer? Nope, that's just a regular business expense for the month. What about advertising the amazing new products we're making with it? Also an expense. The logic is, these costs aren't directly about getting the printer itself ready for use, so they don't get added to its value on the balance sheet.
Okay, so our printer is installed, it's humming along, and it's churning out all sorts of incredible things. But back on the balance sheet, its story is really just beginning. This is where it starts to live out its useful life.
And that brings us to a massive concept in accounting: depreciation. It sounds complicated, but the idea is simple. It's how accountants show that our shiny new printer is being used up, getting older and technically becoming less valuable over time. It's not about the machine physically breaking down. It's really just about systematically spreading its original cost out over all the years that it's going to help us make money.
Now here's where it gets interesting. IAS 16 actually gives companies a choice for this part of the story. There are two paths they can take. First, there's the cost model. It's simple, it's steady. You just take the original cost and subtract all the depreciation you've recorded so far. Easy. Or they can choose the revaluation model. This one's more dynamic. Here, they have to regularly update the asset's value to what it's actually worth on the open market. And believe me, this choice makes a huge difference in how a company looks to investors. Do you want to look steady and predictable, or more volatile, but maybe more in touch with today's market reality?
Okay, let's put some real numbers on this to see how it works. Let's say our printer costs $100,000 in total. We figure it'll be useful for about 5 years, and at the end of that, we could sell it for scrap for maybe $10,000. So using a simple method, we're looking at an $18,000 depreciation expense every single year. And just look at the table. See that carrying amount column? That's its value on our books. And you can see it just drops, nice and steady, year after year.
Which, of course, brings us to the final act of our printer's story, the end of the line. The accountants call this derecognition. What happens when the printer gets old, and it's time to sell it, replace it, or maybe just haul it off to the scrapyard? Every story needs an ending, right?
The process here is actually pretty straightforward, but it's super important. You basically just compare two numbers: what you get for selling the asset versus what its value is on your books. So let's pretend it's the end of year 3, and we decide to sell our printer. If we look back at that table, we can see its carrying amount at that point is $46,000.
So if we manage to sell that printer for, say, $50,000, well, we just subtract its $46,000 book value, and we're left with a $4,000 gain. And that gain goes right onto our income statement. Pretty cool, huh? Of course, if we'd sold it for less than $46,000, it would have been a loss instead.
So, we've just followed the entire life story of one singular asset. But why does any of this actually matter? Okay, let's zoom out now and look at the big picture, especially for anyone who's ever going to look at a company's financial reports.
What it all comes down to is this. IAS 16 gives everyone a common language. It makes sure that when a company talks about its physical assets, everyone, investors, analysts, you, me, is on the same page. It's all about transparency. And this lets us do really important things, like compare how one company is aggressively investing in cool new tech versus a competitor who might be letting all their equipment get old and outdated.
And really, it all circles back to the main goals of the standard itself. Think about it. We've covered the three big pillars, right? First, how to recognize an asset and figure out its true initial cost. Second, how to determine its value on the books over time using one of those two models. And third, how to calculate the depreciation expense as you go. So the next time you're looking at a company's balance sheet and you see that line item, property, plant, and equipment, I want you to remember it's so much more than just a number. It's really the sum of thousands of individual stories, just like the one about our 3D printer. So ask yourself, what story is it telling you about that company's past, its present, and most importantly, its investment in its own future?